Hello everyone, welcome to EPSMomentum.com. So this is the site, this is the first day, you're landing there and you can see all the widgets and functionality there. So where do you start? So first you have the start here button, which is a 14-minute explanation of the strategy. But what is the strategy? I mean, how and why did we create EPS Momentum? Well, so we worked collaboratively with hedge fund managers for more than 10 years, and we interviewed many of them, and it turns out that to make money and to pick good stocks, there's a common denominator in all of the technique and strategies these hedge fund manager employees. They're spotting momentum and follow the trend on several things: earnings, sales, and price, right? So those are the three variables that we follow. So earning per share, EPS, or EPNS, earning, price, and sales momentum, are very important, right? So this is why 6 years later we created EPS Momentum, so that anyone and everyone can actually use those tools. So here it is. Welcome to EPS Momentum. So where do we start? So first, there's three parts. You get the four parts actually. The ticker finder here, so you can put any ticker here. You get the list of pre-canned screener list, and then you have the series of widgets that you can open and close as such. You can just like turn them on or off, sorry. And then at the bottom you have the screener, so you can screen. There's many fields here. You can save your screens when you're done to cherry pick on a regular basis the stock you want. So here we are. Where do we start and how can I use this? So first thing, you can type a ticker. So if I type Microsoft, if you know the ticker, if you don't know the ticker and you want to type International Business Machines, IBM, it also finds the ticker with the name of the company. So very easy, Google, and so on. All the widgets refresh on the ticker that you pull up, and you can take those widgets and open and close them as you wish. So what are all those widgets doing? How does that work? So I strongly advise you to go and look at the strategy here. So the strategy is very simple. It is composed of two things. There's two parts in it. There's the fundamental part and there's the timing part. So fundamental means we're looking at earning and sales and looking for high growth company, very high growth company. I'm not talking about penny stocks. I'm talking about companies that grow at a very fast pace, right? So these companies have very high earning and sales, and so most of the time they launch a new product that is very successful, or they have a new CEO taking over the company, or they have a new service, or they're going into new countries, or they benefit from a period like needs in materials or technology or semiconductor, and they are surfing a good trend. So here it is. The strategy is very simple. You have the earning momentum that is on the chart that you can see here, the EM. That EM is between minus 50 and plus 50. Everything above 20 is a good sign that there is a significant momentum, so we can see it here. See EM 28, so it's above 20, and that means that there is momentum on that quarter, and as you can see, the quarter goes up and up and up, and then there's a big drop due to the pandemic. But this is typical where it's spotted an abnormal, meaning abnormal in a good way, earning and sales momentum, and then the stock rallies for several quarters. So this is what it does. So you would want any company that has an EM greater than 20 is important here. Any company that has an EM less than 20 and even so, less than 0, you can just ignore. Less than 20 is good. They have one of the momentum in there. Between 0, you have one momentum, but above 20, you have two of them, both earnings and sales. So let's carry on. Second thing you can do very quickly, the system is actually buying and selling automatically on paper, just to show you how powerful and what type of return you can expect. How does he do that? Well, the second thing here that we don't talk about is the timing. The timing is composed of those those 3 lines here. So the blue is the ratio of the stock to the index. So you can see how this one has been underperforming the index in the last few days. The index is the SPY, so the S&P. And the green one is the most important. It's the timing bias. So it's whether the stock is in good timing, timing momentum, good momentum, price-wise. It has a lot of things in there. It has percentile, distance to high, moving averages. It's composed of many pieces. There's both a short-term window and long-term window. So it gives you a good indication. Anything above 0 is a good sign and is positive. And that's it. So the yellow one is a very short window of the green. So it tells you it's a 3-day window how the green behaves. If the green changes course, like so here, drops and then go back up, like the timing bias will actually signal it before it moves. So that's key. And what the computer is looking for is it would buy only if the blue, yellow, and green are above 0, and the EM is greater than 20, right? So if we go back in history, see that EM here is 28. All 3 of them, blue, yellow, and green, are above 0. It has bought here on the 31st of July at that price and sold later. So there is a 7% trailing stop attached to the buy order. So there's a sell order automatically that is attached, and it's not displayed here, but it would display what stop level it is, and the trailing stop will just kick you out of the trade automatically. Again, on paper. So that is the strategy 1 trailing. And the second thing is the fixed stop. So some people would say, what would I buy and sell and buy and sell? Well, again, just like keep letting the stock run. And this is what the fixed stop is. Maybe this is not a good example. If we're going to Netflix, for example. So here on Netflix, we can see that the fixed stop, so first the trailing stop has many trades here. It returned 75%, buy, sell, but it got triggered all the time. Netflix oscillates and kick you out. Whereas the fixed stop actually has just one trade. It spotted the system spotted Netflix at $155 in 2017 in June, right? And places a 7% fixed stop there. And that stop got never triggered, right? So if I remove the S&P and I remove the S&P here, it got never got triggered. So now you're sitting on 215% return on it. The third one is the adaptive stop. So adaptive is the same thing, but it's based on earning momentum. So anytime the EM drops below 20, 26, and then 19, it puts a 7% stop below the price of the new earning day here that is below 20. That way, you protect yourself on any downturn in earning momentum. See here, and here, and here. Well, maybe sometimes you miss out on some growth, but it protects your investment from an earning standpoint. So it's a stop based on earnings and sales, which is truly unique. You notice other things here on that chart, the S&P and strategy 3. So what the computer does, maybe it's clearer here. What the computer does, it it actually, let me remove Netflix here. So this is the strategy, and at every single point in time, it has a choice between putting $10,000 on Netflix or $10,000 on the S&P, buying the SPY ETF. So it does that on both automatically, right? So on that day, you bought both. You were better off having the S&P, and then the stock rallied. You were kind of equal. Then you got kicked out, and you get kicked out of both the S&P and the stock. And then you rally again. You have another buy signal. The stock rallies, and then you get kicked out. Stock rallies, then you kicked out. Same thing. S&P get kicked out, and here you get kicked out, and so on. Right. In the end, you were better off employing the strategy than buying the S&P every time you deploy capital. Right. And you can see the difference, 85% difference and 75% here. So that is fairly significant. And you can see all the trades here. If you go look at adaptive stop, let's see the difference here. If we compare to buying the S&P, you're way above if you have bought the S&P instead of Netflix, right? So all this is very useful because it gives you free strategies that you can use and play around with, but most importantly, it removes your emotion. Like you're very often afraid to buy or afraid to sell or too greedy or not enough. So here it's actually the data speaking by themselves. They tell you to get in and then tell you to get out. Now, free to you to do it or not do it and do your research and do something else, but at least it's a it's a mechanical signal that you can use and without any emotion, and that's pretty valuable. That is very important in your investing, is remove your emotion. That's probably the most important lesson here. The second thing or third thing is the profile. So this profile widget is pretty self-explanatory. You have the matrix, the P ratio. So the matrix first, this is the earnings. So this is the last earning quarter. 1.59. Previous quarter was 4 quarters ago. Sorry, the previous year was 4 quarters ago. It was 0.6. That's -1 quarter, -2, -3. This is -4, so that's a year before. This last quarter was published on that date, and the next quarter is on the 21st of October. The great thing here is you can see the percent change, the acceleration, and that's truly unique. You can calculate the you can spot acceleration in a stock. A stock that is accelerating in earnings and also sales. So I can toggle here between sales and earnings. See how it's declining in declining acceleration, but still very high sales, right? So very high growth stocks and declining acceleration. So that's really valuable. You have the same thing on a yearly basis here. You have the surprise numbers and the price change for the actual quarter. Okay, so that is maybe the crux of the site is monitoring the earnings. There's a full video on this. PE ratio gives you another version of a PE, which is much different. So for example, on Netflix here, PEs off the charts, 98, 77, and 55 for forward year 1 and year 2, whereas our PE ratio is at 22. What does it do? It takes the growth of the earnings for year 1 and 2 and then apply the long-term growth of Wall Street at 30%. You would get those EPS 6, 9, 47 on year 1, 2, 3, 5, and 6 to 30. And that would reimburse you for buying the stock at $361. So how many years will it take me to get that $361? Well, guess what? If you sum out 6 plus 9 plus 47, it will take you 22 years to get your money back. So P of 22 compared to 98. So to me, P of 22 is quite cheap based on that growth, right? P of 98 is crazy, and I don't know what that means, like 100. So again, very unique calculation. We call it cashback PE because this is where you get your cash back, very simply. And that's it. You can see the target prices as well. That's also useful. So the drift here is the PEAD, post-earning announcement drift. It's based on the change at any given date, earning date, the change overnight, and the change during the day of the stock. So what it does is, if both numbers are positive here, you're in drift A, and if one is positive and one negative, you're either in drift B or C. Okay, so here we're in drift D because both numbers are negative. You see an overnight pretty steep decline, and then during the day a slight decline as well. What it has shown is, out of the last 20 quarters, 7 of those quarters were in that condition. And statistically, this is the average max, min, and average line that the stock moved applied to the current stock price. So current stock price is 48. If we apply this to that stock price, it would go to 566 or 580, an average of 7.49 up. So let's see. And look, it actually follows the average. The stock price is following the midline here. So that is truly impressive. And if you trade stocks or invest in stocks, I mean, that's a good indication that this thing could go up. Obviously, it could go up or down, but statistically, over its history, it has behaved that way. This is based on behavioral finance, behavioral investing, and human behavior, and market players' behavior. You have funds and hedge funds and mutual funds that are buying Netflix and selling it constantly, and they usually tend to do it in a fairly consistent fashion. So hence the characteristic of every move for every quarter. So that is truly interesting. If we move on to revision, truly unique as well. The revision is very useful. Again, you have a full video here. The revision score here is 969. It was 910 before. It keeps going up and up and up. It has been revised on the 16th of July. Since then, it's been down. So that means Wall Street is kind of negative on the stock. So good to see here. On the holder side, this is the fund. So those are based on 13F. So these are all the funds based on Zach's methodology that are in growth, passive, value, or aggressive, that are investing into the company, right? So you can see like hedge funds have been not investing much, but overall it's a slightly positive investment there. So not amazing. The timing widget, pretty useful. It gives you the last price, the earning day price, so it's below it, so that's important to know. Second thing, the 30-day in blue, and in yellow the 52-week high, so the 30-day high low, 52-week high low. The average true range, one average true range, two average true range, so you can see the risk and volatility, so how much it could like drop, and you see it here. So for $10,000 investment, you have 20 stocks. You have a quantity of 20, and then potentially you could lose $414 if it moves the way it moves, like in one average true range or two average true range. So this is really two average true range move. So that's important to know because you know what your risk is, and obviously it varies with every stock, right? So if I pull up another stock like Tesla, for example, now for $10,000 invested, I can lose more than double, even triple, like I lose $1,000, right? So that's a significantly different number here. Okay, so let's move on to the earning cycle. Earning cycle tells you, based on earning momentum here, horizontal and revision score, where the stock has been and is or has been. There's 4 quadrant: turnaround, EPS momentum, growth trap, and neglected. So they tend to move in clockwise fashion. So if I pull up another example, so for example NVIDIA, here you can see how it's been neglected and all of a sudden it get positive revision. So they're in a turnaround quadrant. This is a precursor of good sign, because meaning Wall Street is positively revising its score for the stock, and then it moves. in general, the earnings get better. As they get better, you get more earning momentum, and that's it. And then turns around here and goes higher up, high earning momentum and high revision. The next step is revision will go down because Wall Street will overestimate the EPS, revision will go down, and then earning momentum will decline, and it'll turn around and so on. So it'll be a clockwise movement. It's important to see in which quadrant you are. So if we put like Tesla in there, let's see in which quadrant you are, right? So Tesla was a turnaround, went down, up, and now it's down. Still negative revision score, fairly high momentum, but maybe it could go on that quadrant here. Who knows? So that is useful. The ROG is pretty useful. Sorry, there's a little bit of a display issue here, but it's basically taking the stock or the sector. So if I put up Netflix, it takes the sector of Netflix and it displays it against other sector and the stock as well. And you can see how they rotate clockwise or not on a daily or weekly basis, right? So this is very useful. You can actually move this in history and see which sector is moving against the S&P. See how they turn clockwise. So I can see it's a little bit similar to the earnings cycle, but this is really the relative movement. So the XLK here or XLY here in green, weakening, lagging, and then improving and leading. When it's in leading quadrant, you're in a good shape here. And then you can do that with the stock and the sector as well. Stock and the sector. You can see Netflix was in leading quadrant and went into weakening. So if I move things, see it was leading and now it's in weakening compared to the other competitors. So quite important things to know. The comparable, it's very simple. It compares stock with each other, depending on. So Netflix is here. It's broadcast, so you can filter by broadcast. Okay, so now I have all the kind of competitors of Netflix here. The important thing is we're looking at ROE, cashback PE, and beta, right? So beta is the size of the bubble. So Netflix has a fairly low beta compared to the others in the sector. It has a fairly high cashback PE of 22 and an ROE of 33, fairly high as well, actually higher than everyone else. So yes, you're paying a little bit more, but you get more return. And you can see other guys here. These are either crazy valuation or we're not able, like P of 99, meaning it's kind of difficult to calculate PE. But if you exclude those, you can see where all the other competitors are. The group is roughly in the 10 and 5 in cashback PE. But the ROE is much lower, right? Here we get a 33 ROE, here you get 23. So again, very useful indicator here. The guidance is usually published by the company. Not much to say here. Sometimes it's discontinued. Most of the time, their companies are discontinuing the guidance. And obviously, the chart here is useful. Okay, so now let's go to the screener that you can see at the bottom. So the first thing you can do is here there's 10 pre-canned screens for you to use. So whether you want to look at best stocks or the best trades ever or the stocks that less reported, you can click and it sets up the screener automatically. So I click on last reporting, and these are the last stocks that reported in the last few days. So you can set to last 25 days with earning momentum being 20, the timing greater than 0, and so on. So now you have 12 stocks to work with. The market score greater than 0, 9 stocks, and so on. You can click and put in the filters, financial numbers. Debt to common equity. This is pretty classic and not very innovative because you can find it everywhere and anywhere. But what is truly unique is all the EPSM analytics, the RRG sector, the signal, the earning quadrant, the actual performance here, or even the EPS matrix. So I want to see stocks that have increase in sales and EPS over the last quarters, right? So give me the ones that increase sales at least one and one in earnings, right? So these names have been increasing in sales, increased sales quarter over quarter, and earnings. Very good earning momentum, a very good timing. And then I can look into revisions. There's many fields here, so you can watch other videos on how to use them. But what you can do is you can go in screens and click on save. You can call it first test. Click on save, and now it's saved. So every time you come back, you can click back here and run your screen. That's it for the screener. So lots of things to find out in the screener. Some of those fields are extremely powerful and leading indicator as to where the stock is going. So watch the other videos on the screeners to see how you can best use that. All right, thank you for your attention.